Okay, so we want to touch on a bit more on this on the investments, where there's a couple or a few different perspectives that people might have and views on investing, and some people like the quick cash flow monthly, or some people are in it for like the long haul. And I'll never sell anything, and I'm okay not making anything monthly as long as I'm paying it off. But I know it's in my house, it's long term, it's locked in. You know, why don't you touch on some of those points?
Yep. I mean, right off the bat, that's why real estate is. I mean, I'm biased, but in my opinion, the best investment you can make, long term, quickly, whatever, because it's tangible for one. You know, if you go to the bank and say, I mean, stock market's great, don't get me wrong, blue chip stocks, dividends, very passive. You know, but you go to the bank and say, I want $1 million in stocks, I'll give you 50,000, and then you want the capital growth on that $1 million, it's not gonna happen. You need $1 million. So, you know, one of the benefits of real estate investing, you know, the biggest benefit is leverage. You know, I'll give you $5,000, you buy a $100,000 unit, and this is, we'll get kind of an example on cash flow. I'll give you $5,000. I mean, obviously now it could be 20,000, but that's still leverage, right? You still don't get that investing in anything else, really. Maybe starting a business or something, but anyways.
You mean 20% down, is that what you're saying?
Yeah, so like 5%, 20% down. So let's say I put 5,000 in or 20,000 in. Well, in 20 years, 25 years, that could be paid off from $20,000 or 5,000 turned into 100. Now, during that time, just because you owe a mortgage on that doesn't matter. You still get the growth on that $100,000. So if you're appreciating 5% per year on that 100,000, 25 years, that's 125%. You're looking at probably 225,000 roughly, if just quick numbers. Hopefully they're right, but you get 225,000 in 25 years, and you've paid off, a $100,000 purchase, with $20,000 in other people's money. Okay, that right there shows the power. So like you took $20,000, you turned it into 225,000, and throughout that time, you're likely making money per month, even if it's $100, it's $1,200 a year. You know what I mean? That's still monthly income. So you're paying down your mortgage. You're getting the appreciation on the full value of what you purchased, even though you only put 5 to 20% down or 30% or whatever. And you can also force appreciation. This is another aspect. If it needs some work, you can also put money into it and get some returns. Construction, that's probably going to be your smallest at the end of the day when you look down the road, depending on what you buy it for. So you got your monthly cash flow, your debt reduction, capital appreciation on the full value of what you purchased, even though it's only, you're only putting in that much, and then maybe some forced appreciation. So to quickly touch on the two things you mentioned, I know I kind of got off topic there, but I think it's important to know. So you have a client who's looking for cash flow, right? There are condos over by Fanshawe, for instance, that you can get for $90,000, $110,000, and still, you have good experience with this recently. $1,200, $1,400, maybe more in monthly income. Yeah. You take that monthly income, and you subtract the debt servicing, and you can still make what? Roughly, some of the examples you've been looking at?
With condo fees, I'm thinking of one in particular for $100,000. With condo fees, taxes, I guess we'll say PIT, you're looking at, it was around maybe $750 a month. And the rents on that unit per month were roughly around anywhere between $1,200 to $1,400.
Incredible, right? So
a month, yeah.
Costs all in, you'd say, were roughly what when you do the numbers on that? After insurance, maybe, condo fees?
But maybe around $800.
Okay, $800. Let's just be conservative and go with $900.
Sure.
So rent's $1,300 roughly?
Roughly. Okay. Sometimes more, sometimes less, depends on your group.
But
they're 3 bedrooms, so yeah.
Let's go even more conservative and say $1,200 on rent. So now you're looking at a $300 spread, which should be okay. We're going conservative on both aspects here, debt servicing and rental income. You got a $300 spread there. Let's say you put $5,000 in. Very tough to do, but if it's your principal residence and you move out or whatever, and let's say you put $20,000 in, just for argument's sake. $20,000, you got $300 a month, which turns out to be $3,600 a year. Okay, you take that $3,600 and you divide it into the $20,000 you put down. Your cash on cash return is roughly what? Let's see here, 20% almost, 4,000. Yeah, like you're pretty close to 20% cash on cash return. I don't know any other investment where you can get a 20% cash on cash return your first year investing in something. Plus, if you factor in let's just say you appreciated 2% per year. Yeah. Let's just say, okay, you got 2% that year. So you got you made a couple $1,000s. I mean, it's equity. It's not really in your pocket, but you still factor that into your overall return if you want to. Cash on cash, 20% plus $2,000. Okay, let's just say you're looking at, now you gained another, what would it be here? Like 5% on that, really. So you're looking at that numbers, and then you look at the fact that you're paying down your mortgage, right? There's more return. But what you mentioned was, cash now. I mean, that's pretty good. You put 20,000 into something, you get 3,600 back.
Even 5. If you can somehow position yourself with the lender to let you put 5% down.
Oh, you've almost made 100% of your money back.
Exactly.
Which is insane,
in year
right?
one. Yeah, in year one.
And you just don't see that. So that's the one aspect. Now for long term, let's go to the other side of the coin. So you got a place near Western, right? That's worth $350,000-$400,000, and you're covering your monthly income. Let's say the mortgage is $1,500 a month. You're probably going to pay off with these rates nowadays. Half of that, at least, I would say, is going to be your principal. So you got a bigger spread. Let's say $850, $900 a month is getting paid off times 10. You're paying off, maybe $12,000 that year in principal, right? They're covering your interest, which is tax deductible against your business costs, or your income, depending on whether it's in your name and in a company is a whole another ball of wax. But so you're paying down maybe $12,000, right? You're not making anything per month, but over time, 2%, which is pretty conservative, maybe around Old North, at least the last few years. 2% per year appreciation on that's $8,000 on $400,000. So you paid off 12, you made 8 in appreciation, that's $20,000. But you're not making any money per month. The difference between somebody like ourselves, I mean, you and I'm okay with that. In 20 years, let's see what happens. We're young, we take a little bit more risk, don't need that monthly income. Had an investor call us this week from Toronto, retired, they want cash flow now. They don't care if it appreciates, they don't care if they sell it for the same as what they bought it for in 10 years, they just want some monthly income, right?
Yep.
So just two different avenues, two great results. It just depends on who is buying the property and what they're buying it for. So you really got to assess why you're doing it, what's your end game.
Right on, yeah.
But again, if anybody has any questions, certainly reach out to us. We can explain these in more detail. There'll be a link to some information.
It's also a great tool on our page as well for a mortgage calculator. If you're ever wondering about running numbers, there's a link that you'll find at the end of our video. It'll take you right to it.
I know my quick take on that before we finish is I always recommend being conservative with numbers. If you're gonna run numbers, make sure that you're a little bit more conservative, because the last thing you want to do is overestimate what your rents are going to be and underestimate what your costs are going to be, which is what a lot of people do when they're selling their property. And what happens is it's a very rude awakening when those numbers aren't what they think.
Yep.
And your return quickly goes from a 10, 15, 20% return down to a 3, 4, 5, maybe negative percentage, depending on how skewed they are.
That's right.